It's important to note that I'm an old and fairly good speculator. And one of the keys of my success has been real discipline. I bought that silver in the $20 range. And I bought it because silver was deeply out of favor. It was hated. I remember actually having conversations with you about the fact that the hate that silver enjoyed guaranteed it was going to go up. And I bought it in anticipation that the hate would subside, and that when the hate subsided, that the price would go up. My price target was 50. I was wrong. I went to 75. And when that happened, the reasons that I owned the position went away. In my life, when the reasons to own a position goes away, the position goes away. The other thing, Charlotte, is I've seen in my life a lot of parabolic stock charts. Canadians call them hockey stick charts. The backside of a hockey stick is just as steep as the front side, and it's a lot less fun. I didn't know where that stick would end, and I didn't care. I did three things. The first is that I took about half the money, not quite half the money, but about half the money, and I put it in high quality silver stocks. My reasoning being as follows. If silver goes nowhere for a year, if it stays range bound, the best silver producers are discounting $45 silver. A year from now, if the price is at 75 or 80, they'll be discounting $75 or $80 silver, which means the stock will be up 50, 60, 70%. The speculative outlook for the silver stocks seem to be better than the speculative outcome for silver. Silver stays flat for a year. By definition, silver won't give me any return. But if it stays flat, the silver stocks will give me 50 or 60%. So it was a better speculative outcome. The second thing I did was about 25% of the money went into physical gold. That's how I save. I maintain liquidity in U.S. currency, and I save in gold. Was gold a better speculation at 2,000 than at 4,500? Absolutely. But that's how I save. And I took 25% of the money, and I put it in oil and gas stocks. As you know, Charlotte, my motto is that I buy hate and I sell love. Silver was loved, so I sold it. Oil and gas were hated, so I bought it.
50% of the money went into buying silver stocks. Are you able to mention any names?
Happy to. And some of them are silver stocks in drag. Wheaton Precious started as Silver Wheaton. Still got an important silver constituency. So I bought Silver Wheaton, second highest quality precious metals mining company in the world. I bought Pan American, used to be Pan American Silver. Huge leverage to silver, including two different 500 million ounce deposits that aren't in production for political reasons. I think $80 silver, $90 silver, and the potential government take on those deposits eliminates the political opposition. And it's on the balance sheet for free. I bought Industria Españoles, which is a not well-known but very large Mexican mining company, the company that controls Fresnillo. And then I bought two silver juniors, Abra Silver, very high-quality junior, and Vizsla Silver, so that I could get a little sizzle in the portfolio.
Rick Rule says he sold 80% of his physical silver because the reasons to own it went away. He reinvested the money into high-quality silver stocks, physical gold and oil and gas stocks. He believes silver may go higher, but speculative upside is lower, and copper and oil offer the next big opportunities. Thanks for watching. Give a thumbs up and subscribe to Fine Metals for the latest insights.
What's happened, interestingly, is that the silver stocks that have performed have been the more marginal ones. Now, there's some rationale for that. If the silver price increases, ironically, the less efficient companies generate higher margin growth because they had low margins, high costs to begin with. So if you look at the performance in First Majestic, big silver producer, but not a low-cost producer, or better yet, Santa Cruz Silver or Endeavor Silver, not the highest quality silver producers in the world, but the ones with the most leverage, those stocks have been on fire. The higher quality silver producers, which have less margin expansion because they're more efficient, have lagged. But overall, if you look at a couple stocks I don't own, Coeur d'Alene and Hecla, sort of brand names in silver, historically not great capital allocators, middle of the road in costs, they've done pretty well. I think oil and gas is 2 years out, 2.5 years out. It's just such a certain event that I'm willing to take the time risk. You may recall in earlier interviews, I talked about the difference between inevitable, something that had to happen, and imminent, which means it has to happen soon. I don't know the time side. I just know it has to happen. If I looked across the commodity spectrum at risk to reward, I would probably urge people to look at copper. The copper price has done pretty well, but it should have done much better this year. It should have done much better because we have a structural supply deficit, and Cobre Panama came out of production, Kakula came out of production, Grasberg came out of production, and Codelco had production halts at 3 mines. We had 7% of world supply come out of production in a market that was already undersupplied. In a normal market, a market that wasn't perhaps recession tampered, one would have expected a 20 or 25% price increase as a consequence of that production decline, which we didn't see. So I think copper has a bit of a coiled spring aspect to it too. Some of the tension, certainly in the last 4 weeks, has been unwound. Copper's done fairly well. But for most of the year, copper seemed really strangely muted in terms of price increase. And make no mistake, a supply shortfall, absolutely inevitable in copper.
Is there a bear case for oil that you can see, or does it all look pretty positive?
No, there's 2 bear cases. One I hope occurs, actually, which is to say peace. I would love to see Iranian society resolve their internal conflicts without too many people dying. I'd love to see that. It would take Iran 5 or 6 years to reinvest enough sustaining capital to restore their oil business. I would live to see peace break out between Russia and the Ukraine, which would, after 5 or 6 years, allow for the resumption of large quantity oil exports from Russia. I would love to see a resolution of whatever disputes are holding back Venezuela. In my lifetime, the hope for peace and an end to political disputes has been often a fleeting hope.
Yeah.
But I would love to see it. I'd love to be wrong on my oil thesis as a consequence of humankind being healthier. That would be great. Yeah. The other thing that scares me is it's been a very long time, Charlotte, since we had a good, thorough recession, never mind depression. And if we had a synchronized global recession, particularly one that was accompanied by a crisis in confidence, AKA a 2008 style event, something that really shook people, you could have lower supplies, which we will have in oil, absent peace, if demand falls, and you still don't get a price rise. So those are the 2 bear cases that I can see. A synchronized global recession or depression, a bad thing by any estimation, or peace, a good thing by any estimation. I couldn't find any platinum seniors to buy, despite the fact that Sibanye is run by a good friend of mine. The political risk seemed extreme. I did buy a couple platinum juniors, and I bought some Sprott Physical Platinum and Palladium Trust because I couldn't find another way to express my preference. The platinum price now is up by, 80%? I'm probably going to sell that fairly soon. For the same reason I sold my silver. I bought it because platinum was priced at less than the cost of production, and I thought it had to go up by 50%, and instead it went up by 80%. So for me, if the reason to own something goes away, the position has to go away.
So is there a case for you at this point or in the future for the small cap uranium stocks again?
Depends on how hard somebody wants to work. The structural market outlook, which is to say the movement of the market for physical uranium from a spot market where prices are indeterminate to a term market, is hugely beneficial for the juniors. There's no other mineral resource commodity in the world where a junior can lock in price and terms for the commodity over 10 years. And that means that they can get bank financing, which they couldn't have gotten 5 years ago. The difficulty with that thesis is that out of 120 uranium juniors worldwide, there's probably only 6 or 7 that have enough uranium to bother with. So you have to be very careful about the wrapper that you express your preference for the juniors in. If you come into a junior and they spend their whole presentation talking to you about the uranium market, time to leave. You need to ask them where they sit in the production cost profile. Are they in the best quartile worldwide? Where they sit in return on capital employed. In other words, are they going to get built against their competitors? It's important to ask these questions. It's important to ask them. A lot of them are going to say, we have great leverage to uranium because we don't have a contract signed. What that means is they can't finance. If you don't have a contract signed and the banker doesn't know that he or she's going to get paid back, they won't lend the money. So what they're holding out to you to be a virtue is in fact a vice. It's important that you know that. It's important when you interview juniors that you determine whether or not they have any economic deposits of uranium. If the price of something that you don't have any of goes up, it should not impact your value that much. It might impact your price, but not your value. I think that we've been through 40 years of very benign economic climate. And I think that people are preconditioned to be confident. People's actions in the future are often determined by their experience in the immediate past. And most people's experience in the last 40 years has been pretty good, you know. The second thing is that I think that people like me underestimate the impact of technology on the economy and the ability through technology to generate more GDP growth with less capital expenditure. I would have expected 10 years ago that the level of government expenditure in Canada and the United States that we would have seen would have done a more thorough job of driving private capital out of the market. But one consequence of technology is that the private side of our economy, not the government side, the private side of our economy has been able, as a consequence of technology, to do a lot more with less. We'll continue to see that. That will become increasingly politically unpopular. Let's say that you are a low-skills worker, but you can get by living 5 to a house with a job at McDonald's, paying $20 an hour. McDonald's is highly likely to automate your job away. McDonald's in the future, rather than having 40 $20 an hour workers, is going to have 4 $60 an hour workers who are machinery technicians. From the economy's point of view, this is a very good thing. From the point of view of somebody who eats at McDonald's, this is a very good thing because it'll moderate their price increases. From the point of view of the 36 employees that get laid off, this is a very bad thing.